Thank you for watching this video. Today we will be doing technical analysis on the stock market for the week ending Friday, January 29th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. We're going to start off with the S&P 500 for Friday, January 29th, and the S&P 500 was down 1.93% on Friday the 29th, and we closed the week at 3714.24. Now, the first chart that we're going to look at is a two-day, two-minute candlestick chart of the S&P 500. I went for this format because I wanted you to see the gap down at the opening of trading. Of course, the dotted blue line is where we finished yesterday, Thursday. And so anything below this dotted blue line, of course, is negative for the day. But you can see we gapped down at the open and pretty much just traded lower all day. Had a little bit of a bounce after 1 o'clock, but sold off into the close and closed kind of near the lows of the day. Not right at, of course, but near the lows of the day. Again, down 1.93% for the day, just Friday alone, closing at 3714.24. The next chart that we're going to look at is a 2-month hourly candlestick chart of the S&P 500. The blue lines are set at 3860 and 3700. What we can see is over the last few days, we got as high as 3860 on the S&P 500 and actually breached that area for 1 hour of trading. And you can see this was really the reversal point right here. On the 26th, we got rejected at that 3860 level, and then we've been selling off since. And then today, on Friday the 29th, we got down and traded below 3700 for just a few minutes, but on the hourly candles, you can see that the hourly candles did not close below 3700. So for right now, the trading range on the S&P 500 is 3700 to 3860. So as long as we stay above 3700 next week, things are probably going to be okay. However, if we trade below 3700, then further downside should be expected. The next chart that we're going to look at is a 1-year weekly candlestick chart of the S&P 500. So each candlestick on this chart does represent 1 week of trading. For the week, the S&P 500 was down 3.31%. But even with this 3.31% drop, the S&P 500 at the close on Friday the 29th is still trading over 10% above the 40-week moving average. The 40-week, of course, is equivalent to the 200-day moving average. So, if all we did was pull back to the 200-day moving average, which, I think definitely could happen, right? I mean, it's a fairly common occurrence. Most years in the S&P 500, you generally pull back to that at least once or twice throughout the year. So, let's not be surprised if that happens. But if we are pulling back to the 200-day moving average right now, we've got another 10+% downside to go over and above what happened this week. The next chart that we're going to look at is virtually the same as the last chart, except what I've done here is I've overlaid the Fibonacci retracement lines on top of this chart. And so starting back on March 23rd, of course, that's where the recent bull market started. So from this point here, assuming that we have peaked, at least for the short term, over the last couple of weeks, the question becomes if we were to pull back 38.2%, which is a normal Fibonacci retracement of a prior move. So the question I'm asking here, asking myself, asking the markets, and sharing with you is if we pull back even just 38.2% of this entire move starting on March 23rd, where would that bring us down to? And the answer is 3231.69 based on where I have the line set. So basically 3250 plus or minus a few points, right, is where we'd end up. Well, that, of course, as you can see, is below that 40-week moving average. So the 40-week moving average would be an easy target, if you will, from here. You can see that if we were to pull back 50% of the entire move, that would take us down to right around this 30 50 area, 30.3315 to be exact. And then if we were to pull back 61.8%, which is another traditional Fibonacci retracement of any move in the market, that would bring us down to 28.3461. So let's just call it 28.50. So 28.50, 30.50, and 32.50 to round these numbers are kind of some areas to watch. That's assuming that we break beneath the 40-week moving average during this correction. Okay, so assuming the market continues to sell off, keeping in mind that February can be kind of a tough month some years, not all years, but some years. So, the trading this week obviously was kind of rough. We had, a over a 3% sell-off during the week. So, it was a rough week. And we're basically slightly negative on the S&P 500 now for 2021. So, further selling over the next few weeks is definitely possible. It's not guaranteed, of course. This market has been extremely resilient, and with all of this stimulus out there, it is completely possible that this market goes right back to an uptrend next week. But that brings us back to this chart here. As long as we stay above 3,700, we're probably going to be okay. And, maybe we trade between 3,700 and 3,860. But if we trade below 3,700 to any significant degree next week, further selling is probably likely. And guys, it wasn't just the S&P 500 that was down this week. Virtually everything was down, right? Small caps, large caps, mid caps, the equal weighted ETF for the S&P 500, the RSP. So, everything was down. You can see that the best performing of all of these was the Dow for the week, only down 3.28%. And small and mid caps kind of led the way. Mid caps were down 5.04%, and the Russell 2000 small cap ETF, the IWM, down 4.38%. So small and mid caps had been the strongest area of the stock market for the last almost 3 months, basically. And now we're seeing some real weakness in that leadership area. So definitely something to pay attention to. And to further underscore the seriousness of this week's price action, guys, it wasn't just the U.S. markets that sold off. International sold off. You can see that the EEM was down 4.57% for the week. The EFA, which is basically the world minus U.S. and Canada, down 3.74%. The FXI, China large cap ETF, down 449 for the week. So there was no place to hide, okay? And I'm going to move over to high-quality bonds here because I want to talk about this, and stay with me whether you're in these things or not. It's so important for you guys to understand this, but especially pay attention if you are 45-plus years old, you're in your 401k or whatever, you're at work, you've got some high-quality bonds, you've got your asset allocation in your 401k, because, guys, the game has changed, okay? And I'm not just saying this, it's math. Stick with me, and this is you'll see this, but and even if you're under age 45, this is super educational for you, so please stay with me here because it's super important for all of us to understand this. Bond yields are so low these days, and the U.S. government and other governments around the world are printing so much money and have taken on so much debt, and they kind of had to. I understand that because of the coronavirus and everything that's happened, but the reality is that high-quality bonds are not going to be in a position to help offset equity risk as they have been in the past. To prove my point, we know that the S&P 500 was down 1.93% on Friday, January 29th. Well, the Treasury bond ETFs, the IEF, the 7 to 10-year Treasury bond ETF, was down 16 basis points today, and the TLT, the longer duration, 20-year plus duration ETF for the Treasury, is down 59 basis points. So think about that. You've got one of the worst sell-offs on a daily basis that we've seen in a while, and these high-quality bonds are negative. All right. Now, yes, for the week, the high-quality bond ETFs are slightly positive, up 6 basis points on the IEF and up 9 basis points on the TLT. But look what happens when we look at the last month, right? You're negative on both of these things. Let's go back 3 months, right? It gets even worse. Let's go back 6 months. It gets even worse, okay? I mean, look at that. You're down 10% on the 20-year plus Treasury ETF, and you're down almost 3% on the IEF, keeping in mind that the yield on a 10-year treasury is roughly 1%. Okay, I didn't look at the exact yield before I started making this video, so bear with me, but roughly 1%. All right, so that's a 1% annualized yield, guys. Okay, so what I'm trying to tell you, and please pay attention, please take me seriously here. I'm trying to help you. Okay, things have changed, and the only way I see most of us winning going forward is if we actively manage our equity exposure to the markets. Okay, we're not going to be left with any choice. We're going to have to adjust up and down our equity exposure based on the risk levels of the stock market. Now, I spent over 20 years of my life developing a risk model, a risk management model for myself. Okay, and the model, I call it Simple Market Signals. It's a trend direction and risk management model that I developed for myself. But once I realized what I had, I knew I needed to get it out there so other people could benefit from it. Okay, so with all of that said, without belaboring this, guys, if you're a financial advisor, anybody in the financial services profession, I've got hedge fund managers, financial advisors, guys that run RIAs. I have mutual fund wholesalers, okay? So whether you're a financial professional, I've got all of those guys numerous guys, right? Lots of financial advisors as my clients, hedge fund managers, other professionals using my service. But whether you're a financial professional or an individual investor that's running any of your own money, including in your 401k at work, your IRA, maybe you're retired or getting close to retirement, please, I spent over 20 years of my life developing this model. I'm encouraging you to spend the next 15 minutes of your life paying attention to the balance of this video, because what I have to say here, guys, can make a huge difference in your life going forward, okay? So with that said, I'm going to tell you some information about Simple Market Signals and how it can help you. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases. And then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors. And what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors. And what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how simple market signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020, so the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February, and then of course the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. And then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow. And then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model. During the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500, in 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market, and it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for simple market signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, simple market signals may help you a little bit, but the reality is that the best fit between simple market signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios, and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked, because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would get in the habit, I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, the emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule. And the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition, so whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least one or two emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.